Thinking about investing? Chances are you don't know where to begin or what you should be investing in. For first-time investors, the world of finance may be a frightening place. As a matter of fact, it's still complicated even for those who are familiar with the process. Many aspiring investors are eager to get started and see their money work for them. But sooner or later, they end up in debt and put their finances in jeopardy. But good news, this can all be avoided. Hello folks, welcome to Money Barrels, where we share mind-blowing facts on different stocks and crypto tokens so that you can stay ahead and be updated on the latest investment trends. If you want to see more videos like these, don't hesitate to hit that subscribe button and the notification bell to get alerts on our latest uploads. Today we will be sharing the top 10 tips for beginning investors to help you get started. So sit back, relax, and get ready to learn something new. Tip number 1. Get started. When is the best possible time to begin making investments? If you've got a long-term view, the solution is always now. The sooner you can start investing, the sooner you'll be on the road to attaining your financial objectives. It is also advisable for prospective investors to begin their first year with the assumption that their investments would decline. Learn to accept the fact that your investment may lose money from time to time, and that this does not imply that you have done anything wrong. In reality, it's more likely to indicate the opposite, that you should stock up on even more while it's on sale. As the old Wall Street adage goes, it's time in the market, not timing the market. That leads to a successful investing strategy. Tip number 2. Know your risk tolerance. When it comes to putting up a portfolio, risk tolerance and investing goals go hand in hand. Your risk tolerance is a measure of your ability to withstand the highs and lows of your investment portfolio in the short term. For some cautious investors, even the smallest price decline might cause worry. For others, even 200% price declines are not a huge problem and are considered as chances to increase their investment portfolio. When it comes to risk tolerance, there is no right or wrong answers. It is just an impartial evaluation of your own personal risk tolerance that may assist you in selecting investments that are suitable for your situation and risk tolerance. Tip number 3. Define your investment goals. When you're ready to start investing, you'll want to create a roadmap so that you can be certain that you're heading in the correct path. This roadmap is referred to by financial advisors as your investment goals, and it is used to define what you want to achieve with your money while you invest. Some investors, for example, are looking for maximal growth, while others are looking for a monthly check. Identifying precisely what you want to achieve from your investments is the first step in selecting investment solutions that are appropriate for you. The ability to write down your goals is also quite beneficial in order to avoid deviating from them during periods of market upheaval. Tip number 4. Find a low-cost investor. The number of possibilities for no-commission brokers has grown to the point that many people no longer need to search elsewhere. Fidelity, Schwab, and TD Ameritrade are just a few of the well-known companies that provide this sort of pricing structure. It is not necessary to invest with a fly-by-night company in order to benefit from zero fees. You may want to explore working with a full-service financial expert as your demands grow, but if you're just getting started, keep things simple and free. Tip number 5. Keep your emotions in check. The first and most crucial thing to remember about investing before you even open an account is that it may be an emotionally charged process. While you could feel joyful following a big market rally, downturn markets can be emotionally draining for many people. Even corrections, which are defined as decreases in market averages of 10% or more, may put a strain on your nerves. However, in order to be successful, you must leave your emotions at the door. When investors sell at market lows when they are concerned, they prefer to purchase at market highs when they are confident. This is one of the primary reasons why investors underperform the market. It goes without saying that this is polar opposite of what you should be doing as a shareholder. The easiest way to avoid falling into this typical trap is to make a concerted effort to keep your emotions out of your financial decisions. Halfway there, are you enjoying what you've heard so far? Give this video a like to let us know. Tip number 6. Practice. Several online brokers now enable you to try investing with virtual money before you commit your actual money to it. This is in addition to offering zero commission trading and a slew of other benefits to their customers. You may use investment simulators to test out different investing strategies or simply to get a sense of what it's like to see your money rise and fall on a daily basis. For a first-time investor, this sort of experience may be really beneficial. It's important to remember that even with simulated investing, you'll need to keep your emotions out of the equation to succeed. Don't be too excited if you do well in your simulated investing and put all of your money at once. Rather, consider it a sign that you are progressing in your understanding of what it takes to be a great investor. Number 7. Automate your investments. Investment success is dependent on consistency, and there is no better way to maintain consistency than to have your investment payments automatically deducted from your account book. As a result of making frequent investments, you might be able to smooth out the ups and downs of the markets, as you'll be putting money into your portfolio when the markets are down. Automating your investing contributions also removes the element of human nature from the equation, which is a positive development. When the market is down, human nature frequently prevents us from investing, and it also creates the chance for us to forget to make monthly payments to our retirement accounts. Put your contributions on autopilot and you'll avoid both of these instances in the future, which will be beneficial to your portfolio in the long run. Tip number 8. Build an emergency fund first. Before you start investing, consider putting money aside for an emergency fund first. If you have no emergency savings at all, you may be compelled to use your assets to cover unforeseen bills if you don't have enough money saved up. In addition to jeopardizing your long-term investing strategy, this might result in extra costs or penalties being incurred. With an emergency fund, on the other hand, even if the unexpected occurs, you may continue to contribute to your savings and investments. Most financial experts recommend setting aside 3 to 6 months worth of living costs, but if you can only start with $1,000, you can handle most non-catastrophic emergency bills, such as a blown radiator or burst kitchen plumbing, without breaking the bank. Tip number 9. Contribute to your retirement plan. Contributing to your retirement plan should be one of your initial investing decisions. A 401k plan, which is offered by your employer, provides not only the advantage of tax-deductible contributions, but it also provides the benefit of profits that grow tax-deferred until you receive them in retirement. In addition, most businesses make their own contributions to employee accounts via matching schemes, which are common. If you don't have access to a 401k, you may still take advantage of most of these advantages, with the exception of the company match, by setting up an individual retirement account in your name. Tip number 10. Don't get swayed by hot stocks. If you follow the financial news at all, you can't help but hear about investors who quadrupled their money in an overnight transaction or equities that climbed 200% in a single week. The video game retailer GameStop was the flavor of the month in early 2021, with its stock surging by triple-digit percentages, including a 400% increase in a single week. According to the most recent available data, the stock was trading at $201.75 a share on March 18, 2021. That is a significant increase over the stock's 52-week low of $2.57, but it is also more than half the distance between the stock's 52-week high of $483 and the low of $2.57. If you go after a hot stock like GameStop, you run the risk of losing a significant portion of your investment in a short period of time. Keep the balance of your portfolio on track by continuously coming back to your investing goals and risk tolerance. Investing surely isn't a job for the weak-hearted, but if you're willing to learn and wait for the results, you may just find this to be your one-way ticket to success. And that's it for our video today, folks. We hope you had a great time learning about these investment tips so you can prepare for your next big move. Don't forget to subscribe, and if you have any questions or suggestions, just type them in the comment section below, and we'll get back to you as soon as we can. This is Money Barrel, and see you on our next one.